Hello and welcome to Inside India. I'm JP Ong and here are your headlines. The Indian markets return to trade today and it's a pretty constructive environment with gains seen across the rest of Asia. Nvidia gets in the ring, joining US and Indian investors in India's deep tech alliance to develop the country's startups. And as the US Supreme Court questions the legality of President Trump's sweeping tariffs, HSBC CEO tells CNBC intra-Asia trade will continue to grow strong regardless of tariffs.
We see this Asia buying Asia driving about 1.8% additional growth to the GDP of the Asian economies. So as a matter of wealth creation is going to be a major trend.
Good morning, and as usual, we'll take a look at how Asian markets are trending in the Thursday morning session. The big question is, was Wednesday's sell-off a bit of a knee-jerk reaction? It seems to be the case with slight recovery seen across major indices from Taipei to Tokyo. The Nikkei 225 now trading about 1.1% in the green, while we're seeing the Hang Seng Index also up by about 1.6% on a big day for Hong Kong tech, the tech sector, as we saw the IPOs, or the listings, that is, for two autonomous riding companies out in Hong Kong. Shanghai also up by about 0.9%, while take a look at the New Zealand future NZX actually out in Wellington, down by about 0.3%, one of the only laggards and only exceptions across this recovery rally we're seeing in the Asia Pacific. And the Indian markets will come online in about 45 minutes. Keep in mind that they did take Wednesday off due to a public holiday. And Gift Nifty futures are now indicating at least that we might see decent gains in today's session and perhaps gains of about 150 points from Tuesday's close. The Indian rupee also something to watch out for after we saw brief signs of strengthening earlier this week, but it is looking a bit softer against the greenback now at about 88.62 against the US dollar. And Nvidia CEO Jensen Huang is warning, quote, China is going to win the AI race, at least according to an interview he gave with the Financial Times. He also added that China is just nanoseconds behind the United States in developing advanced tech. These comments come as Beijing reportedly clamps down further on the use of foreign AI chips. In the meantime, Nvidia is also doubling down on India's deep tech scene, joining a group of US and Indian investors that has now secured over $850 million to back research-heavy startups. Fresh names on the India Deep Tech Alliance include Qualcomm Ventures, Activate AI, and Kalari Capital. The alliance kicked off in September with a $1 billion plan to support startups in AI, chips, space, and robotics. As a founding member, Nvidia will offer tech guidance, training, and policy input to help Indian startups build on their AI platforms. Nvidia's push also comes despite Trump's unhappiness over American firms deepening their push offshore. And now the president's tariffs, too, are on a little shaky ground. The U.S. Supreme Court is raising skepticism with the legality of the levies as it heard a case on Wednesday. The justices zeroed in on Trump's use of the Emergency Economic Powers Act to impose so-called reciprocal tariffs. If the court does break with Trump on tariffs, it would be the first time the mostly conservative court has pushed back on Trump's legal powers. It'll affect billions of dollars that the administration has already collected since April. However, it will not affect sector-based tariffs such as on autos or metals. And while the world waits for concrete progress on trade between India and the U.S. as well as the EU, momentum appears to be picking up with New Zealand. India took its largest ever delegation to visit New Zealand for a fourth round of negotiations on a trade deal. The discussion centered on labor mobility, student and business visas, and sharing agricultural technology. Here's what trade ministers from both sides had to say.
It will be a good trade deal, taking into account the interests of both countries. And this deal will be finalized while addressing all the sensitive issues between the two countries, without compromising on them. We will finalize the deal keeping in mind all these aspects.
Minister Goyal and I, with our officials, have been working very hard. There's been an unprecedented number of negotiating rounds so far, and we're committed to making sure the deal is balanced and is good for the citizens of both our countries. So we're optimistic. The governments have said we must do it, but we're also going to take the time to make sure we get it right.
And India is on course to become the third largest economy in the world soon. The nation's finance minister, Nirmala Sitharaman, said during an address to students at the Delhi School of Economics. Sitaraman underscored the pace at which India's economy has grown over the last decade. Tariffs are one big uncertainty for that growth trajectory, but HSBC CEO is telling CNBC that intra-ASEAN trade will continue to hold up regardless of the tariffs.
So Asia buys Asia is a structural trend, and it's not going to depend on specific tariff decisions. It's going to inherently drive how the economic growth across Asia and the wider Asia and the Middle East going to evolve. We see this Asia buying Asia driving about 1.8% additional growth to the GDP of the Asian economies. As a matter of wealth creation is going to be a major trend. We're very pleased and very fortunate to have presence across all these Asian economies, be it in ASEAN, be it in India, be it in the Middle East, in the UAE, in Saudi Arabia, and other markets, where this flow between China and these economies is happening. And we have a front row seat in being able to support our customers on these fast developing corridors.
Well, increased intra-ASEAN trade might also be good news for India and its possible trajectory towards becoming the world's third largest economy. Is that the case, though? And that is a question we'd like to pose our next guest. Sonal Varma is the chief economist for India and Asia ex-Japan at Nomura, helping us digest a lot of macro developments that could mean a lot of things for one of the fastest economies, growing economies that is in the world. Sonal, thank you so much for joining us. I want to start off first off with those interesting comments from the finance minister, Sitaraman, actually, about India being on track to becoming the world's third largest economy, given how quickly it's grown over the last decade. Do you think she's right? And do you think we might see it sooner rather than later, where you go from number 4 to number 3 with regards to India's economic trajectory?
I mean, we do think that the direction of travel is pretty clear. Real growth in India on a sustained basis, we think, can easily be 6.5% to 7%, and nominal GDP growth of 10.5%. So that does put India on place for significantly faster growth compared to a number of economies, and of course the third largest, which is Germany right now. So the number of drivers here, huge infrastructure spending, relocating on the supply chain, so integration on that front. Services has actually been the big outperformer for India, so that is, in our view, going to continue to be a major growth driver going forward. So there are lots of bottom-up stories in India which support this overall 10.5% nominal GDP growth. So yeah, I do agree. I think it's on track to be the third largest. It's
interesting you bring up infrastructure and consumption, because in India's case, as compared to others, there seem to be two major drivers. Again, that infrastructure spending that could unlock more potential GDP, and also that very sturdy and very resilient consumer base that really has helped it withstand some of the tariff pressure. How important is it going to be for India and these two particular engines to both fire simultaneously to make sure that India can at least continue its impressive growth trajectory and growth momentum?
It's not just infrastructure and consumption. I think all engines need to be firing for India, because India needs to create like 8 million non-agriculture jobs every year. This is a world of deglobalization, and AI is a reality in terms of its impact on jobs. So we require infrastructure, services, consumption, manufacturing, all of that to pick up. I think infrastructure, there are a lot of low-hanging fruits in terms of hard infrastructure itself. And we've seen government actually take the front foot in terms of increasing its own public investment in infrastructure. So that trend, we think, will sustain. What we want to see going forward is actually private investors coming in and taking the baton forward in terms of putting in more capex on the manufacturing side. This could be export-oriented industries, could be domestic-oriented industries. In the consumption space, what we've seen is actually the gradual move up in consumers up the income pyramid, and therefore the penetration of a lot of consumer durables, non-durables, services consumption, which actually tends to pick up as consumer incomes pick up will increase. Now, the foundation of all of this needs to be we create adequate jobs going forward. So that's a big challenge which the government is clearly focused on going forward. And I think the services side, there's a lot of focus on manufacturing, but services have actually been the quiet outperformer for India, presenting steady growth, not just in terms of domestic services, things like banking, finance, but India's exports of services, software, but also these global capability centers continue to be the big growth drivers. So it needs to be a fairly broad-based growth for these targets to be achieved.
I'm glad you brought up services there, because one thing that they've highlighted also amidst all the goods tariffs that we've seen is that India is still punching above its weight, and perhaps driven more so by the services they extend to the world. But again, there are some potential headwinds there also. It's being deliberated in the U.S. Congress, but the HIRE Act really has caught a number of companies in India also a bit off guard, and they've also started to at least monitor this more closely. Again, if the worst happens, if we're doing worst case scenarios where we see tariffs imposed on, or taxes imposed on outsourcing services, how bad is this going to be, and how might India be able to adjust if the worst happens?
I mean, so, in the worst case scenario, if the HIRE Act does go forward, then it reduces India's sort of cost arbitrage relative on the labor side relative to, let's say, hiring somebody in the US. So, for US companies that are looking to move some of their outsourcing to India because it's more cost effective, that arbitrage goes. But I think the arbitrage still stays. Hiring a worker in the US will still be a lot more expensive, even if there is some tax on these outsourcing payment. And second, there is a skill shortage also in the US. So I think, one of the other advantages that India has on services other than cost is just the availability of pool of skilled labor, which will also be much harder. So profitability of companies will come under pressure, but will it reverse the trend on services? I'm not so sure.
Okay, so let's talk about one other external headwind that might be also out of India's control, and that's the tariffs that were unleashed by the Trump administration. And currently the US Supreme Court is deliberating on the legality of this right now. How closely are you watching this? I know it's early days, but is there reason to perhaps be optimistic that maybe these things could be perhaps pulled back and partially, and thus provide countries like India a little bit more breathing room?
I think, most countries, and we at Nomura also believe that the US administration has sufficient legal tools, sections to, go after in case the IEEPA is struck down. So it creates sort of near-term uncertainty and the process of finding what the new route will be, whether it's more Section 301 investigations or, Section 122 investigations. But we do think that some other form of imposing tariffs is going to come through. Therefore, one is watching this closely, but that does not mean that negotiations don't go on. So there is clearly a focus to continue to negotiate despite this near-term and near months and maybe a few quarters of uncertainty.
Okay, so we've been about 2.5 months, 2 months and change since the tariffs were imposed on India. And again, there is an argument that maybe there's a bit of a lag effect. We don't immediately feel the tariffs impacting some sectors because maybe some offloading of inventory, perhaps some residual demand needs to get met. But based on what the Nomura has seen so far, are the vulnerable sectors, I'm thinking about the textiles, the jewelry makers, the shrimp farmers in India, have they already started to feel an impact from these tariffs? Or is there still a little bit more cushion before they actually feel the full force of these?
No, we think the impact is already visible. So the numbers we have for, in fact, August and for the month of September, the specific labor-intensive sectors that you mentioned, textiles, gem and jewelry, have actually seen a moderation in production, and their exports to the US have also fallen. So, for instance, the gem and jewelry sector, from what I recollect, is down over 30, 40, 50% year over year in terms of their exports to the US in the month of September. So there is an impact. But at an aggregate level, the impact is not as visible because of two factors. One is we've seen some initial evidence of diversification of exports already. So in the case of marine products, for instance, which have very limited shelf life, there's already a diversification seen to non-US markets. And this is also true in a few other product categories where we've seen exports to Middle East or countries in LATAM actually starting to pick up. So that's one. And second, during this period, the government has imposed the goods and services tax during the festive season. So that's also offsetting some of the negative impact from tariffs right now. But I think you're right. The true assessment of the impact will probably be visible after November, which is when the GST-related bump up in consumption normalizes and the tariff impact is more clear.
So that bump up in GST, because everyone had high hopes that this was going to turbocharge consumption in India, which is one of the more important engines for that economy. But the question is, was this just a one-time big bang boost for the Indian economy, and might we see a sharp reversion back to the mean, or do you think this is sustainably or substantially increased consumption in India for the long term?
Tax changes don't lead to sustained consumption increase. Prior to when the GST cuts were announced, consumers actually delayed their purchases, so there was a big drop. And once the GST cuts were announced, and because this is the festive season where people do buy stuff, we've seen a huge increase in sales. So this increase is, of course, one-off, from November onwards, we'll see sort of more normalized version of where consumption truly stands. So this is one-off in our view. But there are more structural positives, I think, for consumption. One is inflation appears to have structurally moderated in India and is clearly aligned now to the RBI's target of 4%, because high inflation was a big tax for your low-income consumers because it was squeezing real disposable income. So I think lower inflation is actually turning out to be a bigger positive for consumers. And the monsoon season in India has been good. So we've seen a pickup in real rural wages as well. So that's also lifting consumption overall. So a bit of a one-off, but it probably stabilizes at a slightly higher level compared to where we were before GST cuts were announced.
So inflation and controlling inflation might be more productive, actually, in terms of making sure that consumption is sustained. And that brings us again to one key component with regards to maintaining inflation. That's energy prices and the support for it. We've talked about the pressure from the U.S. to try and make India move away from Russian oil. It seems that we're seeing that happen. However, anecdotally, when you look at Indonesia, for instance, and their attempts in that country to move away from Singaporean gas imports towards the US and UAE, we saw certain price shortages at gasoline stations in Indonesia, and also some shocks, perhaps, in supply actually and energy security there. Is this something that India will have to also perhaps be mindful of? Because, again, shifting energy sources from one place to another in such a drastic fashion could incite shocks. What are your thoughts on this, Sonal? And is this something that we'll have to watch out for, perhaps short-term shocks to energy security in India if it's not managed in a rational fashion, for instance?
I think the government is extremely cognizant of this risk, which is the reason they have actually not agreed to immediately shift away from Russian oil, and which is why India is facing the 50% tariff. So I think the fact that energy security is of such importance for the government from an economic policy standpoint, I think they are preparing, they are well prepared, and prior to 2022, India's oil imports from Russia were less than 2% of total. We're now sitting at 36%. It takes time for refineries also to shift their structure and move to new supply lines. There are contracts that are taken, which again takes time to shift. But with these sanctions that have now been imposed on the two Russian companies, it does make it more difficult for Indian companies to actually buy Russian oil, in our view. And we think, as the wind down phase comes to an end on 21st of November, we will see some moderation in India's imports from oil imports from Russia, and simultaneously we are seeing a pickup in energy imports from the likes of Middle East, some from US, some from some Latin American countries as well. So there is a shift in the pattern of energy flow. which we think will enable India to have a smooth transition without causing any energy security concerns in the near term. And importantly, providing the trigger for the US to bring down the 25% penalty that has been imposed.
And that's something that's very fascinating to watch out for. So now, before I let you go, very quickly, currency risks. Is that something you're watching out for, especially given we've seen quite a increased volatility surrounding the rupee recently? How weak can we go before we start to say, uh-oh, this might actually be a bit of an issue we'll have to contend with?
I think it's clearly a challenge right now for the Reserve Bank of India, because we've seen the trade deficit widen given the drop in exports, and we're going through a period where imports tend to pick up during the festive season, and the capital account is also seeing outflows. So the RBI has been very active actually on FX intervention, both on the spot and the forward front. Now we are heading close to the 90 level on dollar INR, which is psychologically seen as an important threshold. But from financial stability, like external stability standpoint, we don't think it's a concern at all. Given the reserves that India has, we're looking at inflation, which is actually, averaging around 2% for this full financial year. So the spillover, even on the inflation side, is limited. So it's a near-term challenge, which we think RBI is fairly active on intervention. They will, of course, need to counter some of the liquidity withdrawal they're doing because of FX intervention through, other channels to inject liquidity. This is causing some concerns in India because we're heading close to the psychological levels, but I don't think it's a macro financial stability concern at all.
Absolutely, and we'll have to wait and see if the RBI and monetary authorities are indeed on top of some of these risks we've just highlighted. Sonal Verma, Chief India Economist from Nomura, thank you so much for joining us today on Inside India, and again helping us get a better snapshot of the actual economic health out in the subcontinent. Thank you so much once again. Inside India will be back in 2 minutes with more on how the U.S. government shutdown is impacting air travel. Stay tuned. Welcome back to Inside India, and let's take a look at how U.S. equity futures are shaping up ahead of the Thursday session out on Wall Street. And so far, we're seeing that perhaps a flat to the downside implications for the three major indices, the S&P 500, the Dow Jones, and the Nasdaq. Nasdaq, again, also trading with fair value down of about 6 points so far, and continued questions about valuations and perhaps valuations perhaps just getting ahead of themselves out of the United States continue to weigh on markets and investors stateside. Meantime, the ADP's report shows U.S. private payrolls bounced back in October, with companies stateside adding 42,000 jobs. That's a sharp reversal from September's decline, and also beating expectations for a 28,000 increase. But economists are urging caution that's because the ADP data often diverges from the official Labor Department jobs report. And with the government shutdown stretching into a second month, that official report is delayed again. The shutdown has now become the longest in history, breaking the previous record set during President Donald Trump's first term. The Congressional Budget Office estimates it could cost the U.S. economy as much as $14 billion. And that shutdown is also causing the U.S. government to cut down on flights, thus also perhaps adding more headaches to travelers out in the United States. CNBC's Monica Petrelli joins us now to talk more about this. Monica, the decision comes as we're just weeks away from the Thanksgiving holiday travel rush, and just how annoying might it be for American travelers in the coming weeks when they get to this very important but also very hectic season?
Yeah, I'm not sure annoying really captures how some of these travelers are about to feel. But we are seeing the Trump administration announcing now that some 10% of flights may be canceled at some 40 airports starting on Friday of this week. This comes over safety concerns over a continued shortage of air traffic controllers in the United States, a situation exacerbated by the government shutdown, certainly not created by it, however. This has been going on for more than a decade. However, these workers now, well, many working overtime, but without pay. Now, as to the exact markets that will be affected, we are said to hear more about this later today. Those markets will be announced, the government says. Reuters announcing, however, that this increase will start at 4% on Friday, ramping up to a full 10% of flights by next week. Now, international flights. This is important for anybody that has plans to fly into the United States. International flights are thought to be exempt. We do not have confirmation from the U.S. government. However, United Airlines CEO Scott Kirby really confirming this is true, at least for his airline, saying that international flights won't be impacted. His airline instead focusing on regional flights and those that do not connect United airline hubs. Now, he also said all customers flying on United are entitled to a refund. That includes those that aren't even impacted by these cancellations. And he said this also applies to no matter what type of ticket you have, including a non-refundable ticket. Now, this international flight exemption from this really comporting with what I was told earlier this morning by Cirium. Cirium saying airlines will do all they can to protect those long-haul flights, which also are its most highly profitable. Now, as to the future, the shutdown, if it continues, we continue to see that officials saying more restrictions may come, including more delays, more cancellations, even talk of closing U.S. airspace.
I guess nobody is going to be smiling this Thanksgiving, at least with regards to getting to their loved ones. The process of transiting is probably going to be a painful one. Monica Petrelli, take us for those very important updates with regards to the state of transportation in the United States amidst the shutdown. Coming up, the earnings bonanza continues, and we will speak to Mindspace Business Parks REIT exclusively on their second quarter report card after this break, and also a conversation with Allied Blenders ahead of the show. Stay tuned. And welcome back. We are still counting down to the market open in India. Let's take a look, one final snapshot of what Gift Nifty futures are perhaps foreshadowing. And we're seeing still renewed confidence from Gift Nifty futures, which are trading about 140 points above the Tuesday close. Keep in mind that Indian markets were offline on Wednesday due to a public holiday, but they will be coming back perhaps with just a little bit of spunk in them. The Indian rupee now has gone from softness to firmness and is now flexing a little bit against the US dollar, flat to the strong side at 88.53 against that greenback. And we are also still in the thick of earnings season out in India, and a couple of encouraging and impressive report cards to go through. First off, Mindspace Business Parks REIT posting a near 26% jump in quarterly net operating income, and that's thanks to strong leasing and stable occupancy. Its distribution per unit also grew about 13% year on year, and the REIT is remaining upbeat about strong office demand for Grade A spaces. Let's bring in our next guest to talk about this. That is no other than Ramesh Nair, CEO at Mindspace Business Parks REIT, who was smiling after that pretty impressive report card that they just issued. Ramesh, thank you so much for joining us today. And again, when I look at the broad strokes, or the broad strokes at least, it's hard to find something a weakness in the report card right now. If you could identify one dominating factor driving that impressive quarter, what would you say that is?
Thanks, JP. Good to be on your show. If I have to name one thing in the market, I think it's how the commercial office net absorption has been performing. We've just had another record quarter in the market. I was looking at the numbers for the first 9 months, calendar 9 months of this year. And what I noticed was office demand is up 29%. And in the last quarter, if you just look at the quarter 3, which just went by of the calendar quarter, office demand was up 23%. So demand driving the office markets in the country.
Okay, let's talk about that, because when you look at other major markets, like say the US or China, there's still a lot of question marks with regards to commercial office space, but it doesn't seem that India has those questions. Give us an idea of what the opportunity is there. Where is the stock for Indian commercial office space now? How much is expected to grow, and how does Mindspace plan to take advantage of the opportunities that this is perhaps showing?
So the Indian office market is basically 6 cities. We have a significant presence in 4 out of those 6 cities. It's the best performing. We have seen net absorption go up from 25 million square feet to 50 million square feet. We have seen gross absorption go up from 33 million to 75 million square feet. We've seen vacancy rates drop from 18% to 14%. So multiple things. It's today driven by global capability centers. Today, India has close to 1,900 global capability centers who are growing. What we have seen is annual growth of around 20% in the office market because of these reasons. Our focus currently is to grow in these 4 core markets where we already have a presence. Through multiple ways, we are trying to grow organically, where we have close to 7 million square feet, which is under construction. We have 1.8 million square feet of vacant area, which we will lease. We also have contractual escalations and mark-to-market rental growth, which happens on a quarterly basis. Inorganically, we are also acquiring from a sponsor group. We have third-party acquisitions, and we have consolidation happening within the parks. So this is our plan for growth.
Talk to us more about some of these acquisition plans that you have. Is the appetite for acquisitions perhaps growing, especially since we're looking at a global rate environment that might be easing lower and thus making borrowing costs a bit easier for REITs and property players to perhaps participate? Is the appetite, are you hungrier for acquisitions now, Ramesh?
So our interest costs, thanks to repo rates dropping in the last 6 months, have come down from 8.1% to 7.5%. Incidentally, on the acquisition front, we have acquired close to 3,300 crores of assets over the last 2 years, 1.8 million square feet as ROFOs from our sponsor, and 1.5 million square feet as third-party acquisitions. Whatever acquisitions we do, that should obviously represent a strategic milestone in our growth journey. We are constantly looking at expanding our footprints in the 4 key markets. We are also looking at other 2 markets where we don't have a presence, the Delhi and the Bangalore markets. We are always looking at premium, high potential assets, typical institutional owners, where there is scope for development, where there is scope for core plus value add. We look at all opportunities.
Okay, so you identified, are you looking at markets like Bangalore perhaps as a fifth or a sixth, as a fifth destination? And when you go into these markets or perhaps assess whether or not to go into some of these new cities or new markets, what are the key critical things you look for before you decide to pull the trigger on an acquisition there?
So two, three things there, JP. First is the seller profile. It has to more or less be an institutional owner. That's important. What is the infrastructure improvement potential? What's happening there? What's the current infrastructure there in that micro market? Also, any acquisitions should give long-term returns to our unit holders in terms of cap rates, distribution, NOI growth, GAV growth, mark-to-market opportunity. So these are some of the things we look at, Jim.
Okay, so Bangalore might be a potential fifth market in the future, but I wanted to zero in on something that was interesting and highlighted in your in the earnings release. You highlighted strong rental buoyancy, particularly in Hyderabad and Mumbai, two of your four markets. Why do you think these two markets were worth highlighting? Does that mean you love them more than Pune and Chennai?
So Hyderabad, JP, what we have seen is has clearly emerged as a tech GCC hub of the country. We're close to 400 GCCs who are there in Hyderabad. The micro market where we are in, which has around 70 to 80% of the demand in the market, has absolutely no land. That's pushed up around 1.5 years back. Rentals in that market used to be around 75. Today, that's between 95 and 100. We've been big beneficiaries of that. So Hyderabad today, the best performing office market in the country.
Okay, and what about Mumbai? What's driving some of the growth there, and what's keeping you excited there as compared to some of the other markets you're in?
So Mumbai, two, three reasons. Massive efforts from the government to improve infrastructure. It's the BFSI hub of India. Massive availability of talent. Navi Mumbai, where we have a significant presence, is known for its quality of living, cost of talent, good social infrastructure, all that. So these are some of the things today helping Mumbai do well.
Okay, Navi Mumbai, and whenever I think of Navi Mumbai, actually, I think also about data centers, which also has been one of the growth trends we've seen out in India. You've mentioned the GCCs earlier on, but when we look at data centers, is this becoming a more prominent, is this becoming more prominent in the tenant mix of Mindspace REIT, and could we expect more data centers to figure into some of your business parks, either current or future?
So we have two large parks in Navi Mumbai, 50 acres each, that's 100 acres. We already have a portfolio of 1.7 million square feet of data centers. This would be around 285 odd megawatts capacity. Today, what we're seeing in the country is 50% of the capacity building in the country for data centers is happening in Navi Mumbai. We love data centers. They sign long-term leases. There are longer lock-ins. It's diversification for us. Out of the 5 data centers, 3 are under construction and 2 already delivered. So we have played the data center game. In the future, there are some land opportunities available within our parks for further data center building.
Okay, Ramesh, you highlighted global capability centers here, actually, and it is something we've noticed also across other property plays in India. But again, there's still a lot of uncertainties that could come down the pipeline, such as, say, the Hire Act that could impact outsourcing services out of India and the like also. Will the growth remain intact despite some of these new headwinds that could emerge 1 to 2 years down should the worst happen and the Hire Act, for instance, get passed in the United States?
JP, today we have 1,900 GCCs in India. That they occupy close to 280 million square feet. This 280 million square feet is expected to go to 540 million square feet. If you look at the cost of setting up a GCC in India versus the cost of setting it up in the US, we're talking of 20% cost. So it costs, if it's $100 in the US, it costs $20. Let's look at a worst case scenario if the Hire Act comes into play. That $20 could become $24 or $23. So India's cost benefit in terms of low cost of talent, which is 1/10, low cost of real estate, which is 1/8, will still continue, JP.
Okay, and just quickly, Ramesh, before we let you go, you also highlighted in the recent earnings that there were some development works and currently in Hyderabad. Can you update us as to where you are now with the current expansion and redevelopment works you have in that city?
So we have 3 projects which are under construction. One is nearing completion. We have one of the best clubs, what we're calling the Pearl Club, which is around 150,000 square feet. That's getting ready over the next 3-4 months. We have B1, which is a 1.5 million square feet building, which is getting ready around middle of next year. This has already been pre-leased to a global banking GCC. We have another building named B8, which is around 1.7 million square feet, which is going to be ready around the second quarter 2027. This 1.7 million square feet, we've already seen close to 5 million square feet of inquiries for this. So the market, like I mentioned, is the best market in the country today. So, and we are beneficiaries of that. Our total capex spend over the next 3 years across our portfolio in India is going to be around 4,100 crores. And this financial year, our capex is around 1,400 crores. So Hyderabad, all projects. And then we have a 500,000 square feet hotel/office project, which is again there in Hyderabad.
Okay, so Hyderabad, definitely the market to watch for Mindspace Business REIT in the future, and perhaps even Bangalore if the deal makes sense. Ramesh Nair, CEO from Mindspace REIT, thank you so much for joining us today on Inside India and for helping us, giving us more, shedding more light on that pretty solid report card that you had in the previous quarter. We're counting down to the market open now in Mumbai, and we'll be back in 2 minutes to do just that. Currently, we did see Gift Nifty futures foreshadowing a possible gain, at least when the opening bell rings. Stay tuned. You're still watching Inside India. And 60 seconds left for the pre-open before the Thursday session in Mumbai commences. And keep in mind that the Indian markets were offline on Wednesday for a public holiday. We'll see whether or not Gift Nifty futures were actually foreshadowing correctly a possible gain when the opening bell rings. Equally important to watch out for today is the Indian rupee, which again has seen a bit of volatility throughout most of this trading week. It's now looking a little softer against the US dollar at about 88.61 against that greenback. There are a number of reasons perhaps to be a bit optimistic with how equities might perform later on. We're seeing that broad-based recovery rally out across the Asia Pacific, but there are still some concerns about overall overstretched valuations, especially among tech stocks that are exposed to the AI play. and also concerns about a possible equity bubble that could actually burst. Of course, we'll see just how resilient the Nifty 50 is, or might be, to this in about 3, 2, and 1 second. We're seeing here that the Nifty so far is now trading a little bit flat to the upside now, and perhaps just waking up on the right side of bed. We'll see if that holds, because again, it is early seconds into the trading session, but 25,613 points is a pretty decent and perhaps encouraging start for the Mumbai benchmark. Let's take a look at Sun Pharma, which tops estimates, eyeing weight loss drug wave. The country's largest drug maker, Sun Pharma, beating second quarter expectations. Profits for Sun Pharma rose to about 31.2 billion rupees, as mentioned, beating market expectations, while revenue was up about 8.6%. And that's thanks to solid demand in the Indian market. Sales in the United States, though, dipped about 4% amid pricing pressure, and that's Sun Pharma's second largest market. With policy uncertainty also rising, the company says it's open to boosting manufacturing in the United States to stay competitive. The pharma giant is now gearing up to enter India's own weight loss drug market, with semaglutide set to go off patent in 2026. The company says it'll be ready for the launch in the first wave. And shares right now trading up by about 0.4% at 1,695 rupees per share. And RBL Bank says Emirates NBD will launch its open offer on December 12, allowing public shareholders to tender their stock until December 26. This follows the Dubai lender's $3 billion deal to buy a 60% stake in RBL, the biggest cross-border acquisition in India's financial sector. The size of the preferential allotment will depend on how many investors tender their shares. The RBI has signaled informal support for the deal, with the open offer priced at about 280 rupees a piece, compared to the price right now of about 329 rupees a share, also up by about 1.5% in the first 2 minutes of trade. A quick look now at shares of Hindalco. And as we wait for that board to come up, we have to remember the company says a fire at their New York plant, of its U.S. subsidiary Novelis, will dent its 2026 cash flow by about $550 to $650 million. Novelis has already taken a $21 million charge for the incident in the September quarter, despite reporting a 27% jump in consolidated net profit. Hindalco says no one was hurt and the blaze was contained to the hot mill. The facility, though, is expected to restart by end of December with a 4 to 6 week ramp up to full operations. The metals firm is also set to report earnings tomorrow, and ahead of that, we're seeing Hindalco shares down and dropping by about 5.8% in the morning session. And more from the earnings space. Look at shares of India's largest spirits maker, Allied Blenders and Distillers. And they are down by about 2.68% in today's session, at about 654 rupees per share. But again, this perhaps happening despite a pretty solid report card for its most recent quarter. Another strong reporting period for the company, with net profits surging 35% higher and driven by rising premiumization and steady demand across its core brands. Revenue from operations also went up by about 14%. And the maker of Zoya Gin and Officer's Choice whiskey, that is, wants to take on Macallan in the single malt space, with plans for its own single malt whiskey that could expand its global footprint and also its foray into the premium market. A lot of ambitious moves for the likes of Allied Blenders and Distillers. Let's ask Alok Gupta, the managing director at Allied Blenders and Distillers, just how this last quarter actually sets them up for some of these very bullish plans. Alok, thank you so much for joining us today. Now, despite the fact that the stock is down in today's session, we're talking about 4 to 5 straight quarters of strong performance. What do you think has been key in driving the sustained and consistent performance for Allied Blenders and Distillers over the last couple of quarters?
Well, thanks for bringing me in. We've been focused on essentially 4 areas. One is in terms of premiumization, realigning and rejigging our portfolio to sort of make it in sync with how the consumption trends are. On back of it, we have seen our P&A segment grow. We were at about 25% share of sale coming from P&A about 5 years back. Today, it's rock solid 47% and growing. The second area of focus has been on gross margin improvement. Multiple initiatives on that side. One focus has been on focusing on profitable state brand combination. As you know, that Alcobev space in India is state forward and not a national play. We've been looking at cost very seriously. We have invested in backward integration, and all that is showing up in our gross margin, and our gross margins are now up at about 44% and improving quarter on quarter. We've also worked in terms of identifying some of our brands that have a better margin profile and we sort of focused on driving market shares for those brands as well. So a combination of premiumization, picking up the right scale brand combination, and bringing the cost down, leading to margin expansion has been the focus area. And that's led to where we are quarter on quarter, building block by block.
All right, let's talk about the premiumization in just a little bit, Alok, actually, because I wanted to ask you about GST reforms, which really generate a lot of buzz and excitement for consumption-focused companies, such as, say, yourselves. We did talk to Sonal Varma from Nomura earlier on today, who said that while it did give a boost to consumption in India, it could be a one-off, and we might see a reversal back to the mean. Has the GST reforms perhaps led to higher consumption and benefited Allied Blenders? And are you also expecting perhaps this to be a one-off thing or a sustained boost to consumption of your own products?
Well, I think if you look at the H1 performance in terms of consumer demand, it's pretty rock solid at about 6% by volume term and about 9 to 10% in terms of value. GST reform did kick in. There's a reduction in the income tax that also kicked in this financial year. So I think we are seeing H1 buoyant in terms of the value growth. One of the points that I've been increasingly making is that for India to focus now on value growth and not just on volume growth. Festive season has just kicked in. I think we stay very, very positive on the festive season. October is a good month for the industry. So I think from our perspective, premiumization trend will continue and consumer will choose to drink better over just drink. I think that trend will continue to drive higher value and better margin growth.
So we've been talking about premiumization for quite a bit here, Alok. Do you think that this is the trend or this is the direction for the spirits market in India right now? That we're seeing more upside perhaps from consumers moving up into and affording higher end and higher quality brands? Or do you think the mass market is still going to be where a lot of the growth is? What are your thoughts as to which segment might outperform the vis-a-vis the other?
So I think there are a couple of drivers. To make a generic statement that premiumization alone will drive the margin story would be incorrect. So I would pick up maybe 3 or 4 key trends. First, I think is to look at what we call as the super luxury to super luxury segment, which operates at a price point of, let's say, between 2,000 Indian rupees all the way upward. It is 3% by volume, growing significantly high double digit and accounts for nearly 20% of industry brand margins. So we are very, very confident. We build a very large portfolio out there. So we are confident that the luxury adoption will continue to in India. A lot of our Indian brands, including the Indian single malts, are becoming globally relevant. So the growth will not come only on domestic, but also will come on back of international sales. APIDA, which is India's leading industry body, is working with the Indian manufacturers to drive export from current level of about $350 million to about $1 billion by 2030. So there'll be a lot of focus on not just India, but beyond India. The second thing is that even within traditional segments and traditional flavor like whiskey and brandy, we are seeing an increasingly high acceptance towards newer flavors. So the consumer is also wanting to experiment. So we will see consumer wanting to spend a little more for the little extra experience, whether it's a mass premium or a prestige play or a luxury play. So I think for the next couple of quarters, our ability to keep on building right kind of brands with right kind of flavor profile, we believe would be a way to go.
And one of those things that's also perhaps in the pipeline for Allied Blenders is that premium single malt whiskey by 2029. But you're not the only game in town, Alok. Of course, we do know the likes of Indri and Amrut that have captured a lot of approval, not just in India, but also globally. How are you planning to compete with that, given the fact that we're also seeing a lot of other players coming up in India and that you'll be one of the new premium single malt providers coming from the subcontinent?
Thank you for asking this question. I think our focus has been on what's our right to win. We are building India's first single malt distillery. It's getting built in Rangapur. We've looked at how single malt across the world are getting built. So there are single malt coming from Thailand, from China, and from the US, other than the traditional Japanese and Scottish single malt. So we are trying to bring in our single malt distillery, 2,000 years of history of Rangapur, building a character of a brand in terms of not just the liquid, but also how it's going to get mature. Second thing, what we're doing is that we are the largest exporter of Indian alcohol And what we're doing is that we are expanding our global footprint. We've gone from 17 countries to now 27 countries and pushing to about 35 countries by end of this financial year. We opened up both traditional markets like GCC and also North America, Australia, and a lot of Southeast Asia. So what we're working towards is building an excellent product driven by authenticity, and more importantly, building global distribution. So when the product is ready, we're able to sort of hopefully create a great launchpad for the brand.
All right, very exciting. And as we can see here from that map, the footprint, the global footprint of Allied Blender Distillers also seems to grow by the week. And we'll see just exactly how we're expecting at least just how the launch of the single malt whiskey will be by 2099. And if you decide to do it earlier, please let us know. Alok Gupta from Allied Blenders and Distillers, thank you so much for joining us today on Inside India and sharing with us the outlook for the company and how those earnings results actually support your future plans. Let's take one final check now of how Asian markets are trending. We noticed a broad-based bounce back, that is, for these major markets. And again, we're seeing that play out today. Again, perhaps just still a bit of ground to make up from Wednesday's tumble. But so far, the Nikkei 225 and the Kospi also leading gains today after pulling back significantly. Perhaps the most impressive one, the standout today, has to be the Hang Seng Index. Of course, a big day in the IPO space once again for Hong Kong, with two autonomous writing companies, WeWrite and Pony AI, debuting on the Hong Kong markets today. The Hang Seng Index getting that rub-off up by about 1.7%, and Shanghai also not looking too bad. They're up by about 0.9% out in mainland China. Keep an eye also on the TAIEX today. They are also a tech-heavy index and trading about 1% in the green. And apparently that's all the time we have today on Inside India. But do keep watching CNBC because Access Middle East is up next. Have a good morning.